The following is a 20-minute segment of a 90-minute presentation for Potomac clients and invited guests. To be considered for future presentations, contact us at events@potomaccompany.com.
Everyone, thanks for stopping in today. As Patrick said, sent around some bullet points about what we're going to talk about, but based on some conversations I've been having over here at Potomac the last couple of weeks, I'm definitely going off script. And what I'm going to try to do today is I'm going to try to make this really a behind the scenes, never been seen before type webinar. We're at capacity from a webinar perspective. We've invited our clients, and we've invited some folks in the industry, as well as we've invited the Wall Street equity research analysts, and it looks like they're all here as well. So we've got a full house. I'm going to try to keep it clean. Patrick is a church deacon, so he's going to keep me in line today.
Thanks, Paul.
We're using Zoom. I'm not particularly good at this. I understand people hack Zoom and porn shows up. So if you see porn, it probably is not mine. But let's go ahead and get this started. I could literally do this entire presentation on one slide, though I won't. But I really could do this entire presentation with this slide alone here, as there's a tremendous amount of information on it. And let me get myself a laser pointer. This dark blue line here is the Potomac Pest Control Index. This is kind of our proprietary in-house weight of the publicly traded pest control operations out there. And this information, as well as this dark blue blotch that we'll go through, largely informs a lot of things we do over here, not only from a preliminary evaluation perspective, but even the sell side process. And so there's a tremendous amount of information on this slide. So let's talk about this for a second. These aren't stock price charts as much as they are trading statistics. So essentially, if you look at this light blue line here, it is the S&P 500. And what this shows is the average, it shows the enterprise value to revenue of the S&P 500. The same thing with the PPI. So this line here shows the publicly traded pest control comps out there, trading on a multiple of revenue. I'll say this on the upfront, revenue does not drive pest control transactions. It's driven by cash flow and the growth rate in free cash flow. But if I went into EBITDA and EBITDA minus CapEx and all sorts of crazy charts, it would complicate this. And I want to keep this simple because we've got a lot of ground to cover today. This block down here is essentially 263 private market pest control transactions over the last 20 years. So we've charted the highs, the lows, in the middle. And I think to get this party started, we're going to kind of talk about this. I mean, if you look at this 20-year history in pest control, you start with, you've got the S&P 500 back after the back during the run-up of the dot-com bubble and then the ultimate crash. The S&P 500 traded for a little bit above 3 times forward revenue. But of course, by the time we got to the financial crisis in 2008, 2009, things really hit the skids. And the S&P 500 index is appreciated therefrom. But what really starts to get interesting is what happens to the publicly traded pest control comps, or the acquirers as we know them. And this index is a mismatch of Rollins, Rent-A-Kill, and ServiceMaster. Ecolab is not in this index. Prior to the financial crisis, is traded pretty much in line with the S&P 500 for the most part. But once we got into the 2008, 2009 financial crisis, we hit a fork in the road, and there was just spectacular appreciation of publicly traded pest control businesses versus the S&P 500. Again, this is enterprise value to revenue. This index, the PPI index, you can see as it's gone up, it really has kind of pulled private market transactions with it. And it's really this type of stuff that allowed me to effectively I called the top last year, November 8th, at around here. And so it's this data, both private and public, that allows us to do this. But If you take a stroll down memory lane here, Orkin bought PCO Services in Canada back in 2000 for 25 million bucks. It was a $25 million in revenue business. Now, and quite frankly, that was at the high end of the range back in 2000. If you were to do that now, you wouldn't be able to, if you did that in 2019, you sold your $25 million business for 25 million bucks, you wouldn't be able to show your face at the Christmas party because you look like a real jackass. But that's what these deals were getting done at back then. When I got into the pest control industry, it was around 2003, end of 2003. My history, I come from bulge bracket investment banking. I worked for Lehman Brothers, industrial M&A, and then I did software and tech M&A for Credit Suisse. Then I went into the buy side and worked in private equity. And when I came into pest control, one of the things that I found extremely interesting is there was no multiple expansion. I mean, you look at most other industries, small pest control or small businesses tend to sell at lower multiples than larger businesses. But back in the early 2000s, that really wasn't the case in pest control. All the way up until the financial crisis, J.C. Ehrlich, Rentokil bought J.C. Ehrlich back in 2006 for 1.1 times revenue. It was a $141 million deal. It was a whopper of a deal back then, but at again, what we would view today as a very laughable multiple. The Keenan sold Waltham for 1.3 times revenue back in late 2010, and that's when we first started to see multiples appreciate. For the majority of history here from 2000, or actually before 2000, but up until around 2011, 2012, really there were only two acquirers in the United States, Rollins and ServiceMaster. Rentokil did a few deals here and there, and they did a whopper. But for the most part, it was Rollins buying commercial players, Terminix buying termite and residential players. But it wasn't around until 2012 that Rentokil really got serious about growing its U.S. pest presence, and we're going to talk about that on the next slide. But for now, another deal that was done in 2012 was Western. So Western owned Target, which is a pesticide and chemical distribution business, but it was also about a $90 million in revenue pest control business. The whole package sold for $149 million. This transaction was a real shame because, these guys probably left somewhere between $25 and $50 million in purchase price value on the table. And I did an article on that years ago called The Curious Case of Western Exterminating, but these guys really screwed this one up. And instead of being on the high end of the range and maybe selling for $1.50, they sold for $1.10 down here. We get to November of 2015, and then we started to see multiples that previously were unimaginable. StairTech was a controlled auction process, sold for 2.8 times revenue. Really entirely unseen unseen prior to that. We moved forward in the middle of 2017. That was the first 3X deal. We sold a business in the summer of 17. It was the first real 3X deal in the pest control industry. By 2015, 2X was the new dollar for dollar. And then by 2016 into 2017, 3X became the new dollar for dollar. Nowadays you call up a $1 million pest control operator and he's shocked you don't want to pay him $5 million for his business. So things really began to ramp up in 2017. 2018, deal, we broke 3.5X for the first time. We did that deal in December of 18, about a month after I called the top of the market. We saw further appreciation and later in 19, and of course the StairTech of 2019 was ServiceMaster's entry acquisition into Europe. We completed that deal in September of 2019 for 3.7 times revenue, the highest priced pest control deal thus far in history. But what I want to do is get rid of some of this public market stuff and talk about, I want to talk about multiple expansion for a second. Again, if we look at this, what you're seeing here is all of the 263 private market pest control transactions plotted on this chart. Again, until around 2012, the extreme majority, probably almost out to 3 standard deviations of transactions were done between 70 cents on the dollar and 1.3 times revenue. As we get post 2012, we start to see what we call multiple expansion. And this is what we should typically see in a very healthy M&A market. And here's what I mean by that. As kind of a rule of thumb, over these years here, businesses that were doing $1 to $3 million in revenue tended to sell somewhere between $1 and 2 times revenue, give or take. In order to get above 2 times revenue, you started to get into the 3 millions. And then, in order to really start to see 3X and higher, you were typically a $5 million business. Now that wasn't a hard and fast rule. In November of last year, we sold a $2 million business for $5 million. So that implies a 2.5 times revenue for a real small business. You see some transactions, like a Western would be example. In 2019, ServiceMaster went out and bought a PCT top 100 company that didn't go to auction. It was just a private deal. Should have been a 3X deal. That was a 2 times revenue deal. Bought one in 2018. It was a $17 million revenue top 100, but I don't think they reported on the top 100. And they got a fantastic deal. But for the most part, this tends to be how this stuff breaks down. From a historical perspective, really what kicked this off is, as I said, Rollins and ServiceMaster were the pre-2012 duopoly. Rentokil really decided that it wanted to be a pest control business in 2012. And essentially, Rentokil is an integrated facility services business based in the UK. It's an amalgamation of a hygiene business. At the time, they had CityLink, which was a courier postage parcel business, a variety of different services, plant health, hygiene, so on and so forth. But they looked at Rollins, and Rollins is always trading at an extremely high multiple, and said, how can we be more like Rollins? We want to trade at a higher multiple in the public equity markets. So they reasoned, if we increase our portfolio of pest control business, we can look more like Rollins, because prior to 2012, Rentokil was less than 50% of the revenue was pest control globally. And so they began to ramp up heavily. And as you can see here, it was really Rentokil getting into the mix, ServiceMaster's doing deals, Rollins, but they started to drive things up. Rentokil really accelerated in 2015 as their cost of debt capital under quantitative easing began to decrease. And then by the time 2016 rolls around, Anti-CMEX enters the United States. And we had done deals with Anti-CMEX for years, largely in Europe and in Asia. They finally entered in the summer of 16, and now we had another competitor. This is an interesting dip in private market multiples, and in about a second, you're going to see why that was. Memphis shits the bed, part 1. So this is ServiceMaster in the fall of 2016. Their board said, hey, you guys are a bunch of idiots. You're using M&A as a crutch. It's time to quit doing deals. So from essentially from Halloween 2016, almost through the end of 2017, they did a total of 16 or 17 million in capital spend on acquisitions in a 14-month period. So that impacted the market, as usual. We had our first busted ServiceMaster deals took place there. Of course, in early 2018, late 17, early 18, we got the new management team. Nick Vardy comes in, wants to buy anything that moves. We'll do pest control, we'll do restoration, we'll sell candy bars, we'll brew beer. I mean, he really wanted to just buy anything he saw. They ramped up the spend. And then, of course, we all know what happened in October of last year. Memphis once again hits the skids, and we began to see weakness in the pest control M&A market as transaction multiples began to contract. And we're going to talk a little bit about that later in this presentation. One last thought on this. Again, 95% of transactions, or I'm sorry, 95% of the deals that are in this range, the high 2s and into the 3s tend to be 5 million in revenue or above. And again, guys, this is a historical look. Towards the end of the presentation today, we're going to talk about where we are now and then where we may or may not be in the near future. A few things I'll point out. Here's the acquisition capital spend for the strategic acquirers over the last 3 years. In 17, so this bright blue line here, or box, represents ServiceMaster. So as you can see, they did 16 million in 2017, not a whole lot. Rentokil's been pretty consistent year over year. And it's really been Rollins that's bounced around. Rollins typically, as far back as you can go, I mean, Rollins was typically between a 65 million and 120 million in acquisition spend. We have the Clark outlier here that kind of boosted it up, but literally from 18 to 19, we went from 700 million in ac spend to almost 1.4 billion. So really a tremendous amount of acquisitions, which really was the cause of this massive widening here. I want to talk a little bit about multiple arbitrage, and I wasn't going to talk about this today, but I've had 3 calls over the last couple of weeks, and the 3 of you know who you are because you're listening to this right now. And you called me up and said, hey, you've always talked about multiple arbitrage, buying businesses on the cheap, packaging them up, turning around, selling them. You know, back in 18, in my Calling the Top article, I talked a lot about what I call multiple arbitrage. I don't know if that's a real precise term. I mean, the real meaning of arbitrage is making a riskless profit by simultaneously buying and selling an asset in a different market. So you buy gold in London for $1,700 an ounce, and you simultaneously sell that gold in New York for $1,705, thereby pocketing a 5% riskless spread on the price of gold. And pest control doesn't really work that way, but we've had a ton of success. I mean, I talk about in 18, we had a client doing 35 million in revenue. We bought a $10 million business. The same year, turned around and sold it, made a massive profit. I talk about the fact that over the course of 18, we've noticed a material widening of the spreads on transaction multiples across size segments of the industry. So here's, again, this is what I was talking about. We get into 18 and we start to see multiples really expand. Small deals getting done here, medium deals getting done here, larger deals really starting to get done there. In January of 2018, we began putting together materials to take a business into the market. Simultaneously, we're looking at a $2.5 million target, which we ended up buying for $1.1 million. Or I'm sorry, not $1.1 million, 1.1 times revenue, or $2.8 million. Took the business out to market, ran it through an auction, sold the whole package, including the acquired target, at the end of 2018 for a grand total of 3.55 times revenue. This allowed the shareholders to literally pocket, I wouldn't call it a risk-free because it's never risk-free because it's not a simultaneous sale and purchase, but all things were moving forward. We had no reason to believe that the market would conk out. So we took the risk, bought that business, and it was at a price where we would have kept the company whether or not we were going to effectively sell it. So, but 6.2 million in profit just by playing the arbitrage game was pretty commonplace in 17, 18, and 19. And, you know, folks are looking at doing the same thing right now. I think right now is probably, given the COVID situation, is probably not the best time to get bargains. I think if you find an opportunity that you can go out and buy and you get you can get it for the right price, go out and do it. But you got to kind of push the arbitrage play out of your mind because, again, we don't know what the market's going to look like in the coming months, which we will talk about here shortly. Now, I wanted to talk a little bit about, now, I know when Patrick sent the invite out, he talked about value creation in the pest control industry. And, you know, I could talk about recurring revenue and relative pricing. I could talk about cash flow and growth rates and so on and so forth, but I want to skip all that. And I think if I think about, you look back through all those past transactions there, and I look at some of the highest price ones, I try to differentiate in my mind what makes some of those deals price as high as they did versus some that did not. And I can't cover everything today on the auction process, but I'm going to give a quick run through of the actual No More case study. And because ServiceMaster has buried the actual numbers in their public filings, they've been disclosed, I'm going to give you guys a real live view of what the actual bidding process looked like and how we ran that process and how we got it to 3.7 times revenue. Because I think on the margin, I think some of the big distinctions between some of the deals that historically over the last few years have sold at 2, 2.3, 2.5x versus the guys that have sold at 2.5 to 3.7 times. A lot of that has to do with the actual sell side process. So we're going to go ahead and get started.